Hi, I'm Ray Meadows, Prince of Finance, and today I'm here on my own to talk about this. It's March 1st, and because of the coronavirus, the stock indexes in the US are down 12% in 6 trading days. So, investment market stocks, bonds, and mutual funds are driven by two major kinds of factors. One is economic factors, so supply and demand and how that affects the future cash flows to the securities, and those cash flows give those securities values to us as investors. And then the other major factor is the mood of investors and traders when they're trying to decide what price they should pay for those securities to earn those cash flows in the future. And when I say that, I mean they're thinking about, oh, the future is uncertain, there's risk, how do I feel about that risk? That feeling drives how interested they are in either buying or selling. So the range of their mood goes from very pessimistic to very optimistic. And when they're very optimistic, they're willing to buy at a higher price and more stock. And when they're fearful, then they really want to sell, and they're anxious to sell even when the price is going down. Now, the coronavirus epidemic is driving the market via both of these factors right now. And I'm going to give you my opinion about the economic effects. And I don't know what will happen, but these are the ideas that are driving what other investors are doing and therefore trading in the market. First, let's look at the economic effects. On the supply side, there's a huge supply disruption in China right now. A lot of the factories are shut down, and China supplies parts and supplies to the rest of the world. So there's auto factories in Europe that are shutting down because they can't get their parts from China. And when the coronavirus moves to other countries like Korea and Japan and Italy and eventually the US, the same things happen there. People stay home, people are quarantined, they can't go to their jobs. Some people can work from home, but then there's a lot of jobs where they have to actually be there. And so those things won't happen. And so that disrupts the supply. For example, Apple Computer makes a lot of its phones in China. They've already announced they can't get their phones out of China. So how can they sell phones if they're not getting them? So that's the supply disruption side. The other thing that happens is people don't go out and spend money on the same things. The movie theaters in China are empty. No one's getting on planes. They're not going out to restaurants. So demand is also affected. So you have both supply and demand affected. And China's a very large economy. These are going to have worldwide impacts. So that's going to affect businesses' earnings and cash flows. And so investors are thinking about that stuff. So, for example, energy companies, oil prices are going down, people aren't traveling, retail stores in China, a lot of them have closed. The same things are going to happen here. Financial companies are going to lose money when people don't pay their loans back. Health insurance costs are going to skyrocket. The insurance companies are going to spend a lot of money is what I'm saying. So now let's consider some other factors. Let's consider the psychological impact on investors' attitudes in when they're buying and selling securities. Right now, optimism is being overwhelmed by the fear of the unknown. That's why we see a very sudden and large drop in prices. We don't know how bad it could get, and therefore the price is suddenly much more risky than it was before. People that might have stepped up and bought stocks 2 weeks ago are suddenly going, wait a minute, I don't know what's going on. I'm afraid to take a chance because I really don't know. So that fear is driving them to sell, even separate from the idea that the earnings and cash flows are lower. So fear is taking over where before we had extreme optimism. So stock prices were very high, valuations were high because investors were thinking nothing can go wrong. And now all of a sudden, now they find out they're wrong. So what should you do? Should you buy? Should you sell? Some people think, oh, the price has gone down, maybe I should buy. Well, it sort of depends. If you were a prudent investor, you adjust your risk so that you can withstand whatever is going to happen without doing a lot of huge changes right at the wrong time. You don't want to have to sell when the market's low. Okay? You want to buy low, sell high. That's how you make money. So you have to position yourself to be ready for whatever's coming in the future. Should you buy depends on your situation. How long can you leave the money invested in case it goes down further? How much risk can you take before you chicken out and sell? And that, those sorts of things you have to ask yourself. Should you sell? Should you get rid of your positions? Timing the market is very hard. We never know. It can go up, it can go down, it could rally tomorrow 10%. We don't know. So the idea is you need to keep your investments in such a way that you can withstand whatever is going to happen. Don't run out and buy just because it moved down a little bit. Don't go out and sell just because it moved down a little bit. You have to think about what you can handle, because the stock market can go down another 50% easy. And so you have to be positioned so that you can handle that. If you can't, then you should be reducing your risk. You should sell if you can't handle that. Remember, if it goes down 50%, then to get that back means you have to have 100% gain. A little tricky math there. If you had $100 and it goes to 50, then guess what? Once you're at 50, you need to make another 50 to get back to your 100. That means 100% gain. So it's better to avoid losing money than trying to make it back after you've lost it. Now, I want to talk a little bit about some of the specific investment types that we've discussed in the past. Money market mutual funds. As I've said before, those are the safest things that you can invest in. And right now, I don't think you have to worry too much about those sort of things. The other thing I talked about especially for beginners, is investing in bond funds. And right now, bond funds might be moving around a little bit. The investment grade bonds will actually be going up in a crisis like this. And some of the riskier bonds will be going down just like the stock market. But you don't have to worry. I would keep in mind that when you're investing in bond funds, you're getting your returns from the interest they pay. So you're not relying on other people paying a higher price to you later. They're going to pay you cash flows into your account. So even if the price goes down, I wouldn't worry too much about those kind of investments. Stock funds, on the other hand, can go down a lot. And most of the return from stocks comes from selling them to someone else at a higher price. So you need people to be optimistic when it's time for you to sell. So if your time frame, on the other hand, is say 10 years or 20 years, it's in your 401k, you're going to retire later, don't worry too much about that stuff, because in the long run it'll eventually come back. As long as you don't have so much risk that you're going to get nervous and sell, it's okay to keep that stuff. But don't have so much of it that you're nervous and want to sell. And also, if you're going to need the money in a short time, when I say short time, I mean the next 3 years or so, then you may want to sell before the market goes down too much more. So that's about it. Those are the kind of things I wanted to talk about for your investment portfolio and what you can think about when you're evaluating the impact of the coronavirus on your investments.